Ever heard someone say "buy the dip" or "I'm investing in stocks" and just nod along without really knowing what they mean? Most people have been there. Stocks can sound complicated, like some secret language only financial experts understand. But when you break it down, stocks are actually something you interact with every day, even if you don't realize it. Welcome to Precision Net. And today we dive deep into stocks, what they are, how they work, and why people buy them. This isn't some boring lecture. This is you finally understanding a topic that affects billions of people and could one day grow your money in ways you never thought possible. So let's start at the beginning. What is a stock? A stock is a tiny piece of a company. When you buy a stock, you're buying a small ownership share in that company. You don't get to call the shots or run the business, but you do get to benefit when the company does well. Imagine your friend starts a small tech repair shop. If you give them money to help them grow, you now own part of that shop. If it becomes the most popular repair shop in town, your slice becomes more valuable. That's what owning a stock is like. Think about Tesla. 10 years ago, if you invested in Tesla when it was still ramping up production and delivering a few thousand cars a year, your shares would have been relatively cheap. As Tesla grew, built gigafactories, and sold hundreds of thousands of cars around the world, the value of that small ownership you held increased significantly. That's why early investors saw huge gains. This is one powerful example of how owning stock in a growing company can change your financial life. Now you might ask, why do companies even sell stocks? Why not just borrow money or use profits? Companies need money to grow, to build factories, hire workers, develop new products. Borrowing money means interest payments and strict repayment terms. Selling stocks allows companies to get cash from everyday people, and in return, those people own a part of the future growth. Amazon did this in the late 1990s when Jeff Bezos needed capital to expand beyond books and build what became a global empire. Investors who bought Amazon in the early days saw massive growth over time. So how do investors make money from stocks? There are two main ways. One is through price gains. You buy a stock at one price and later sell it at a higher price. That difference is your profit. For example, if you bought a share of Apple at $150 and later sold it at $250, you made $100 on that share. The second way is through dividends. Some companies pay a portion of their profits back to shareholders regularly. Coca-Cola and Procter & Gamble are classic examples. Dividend investors love these companies because they generate steady income while they hold the stock. Stocks are bought and sold on stock exchanges. Think of them like marketplaces. You can't just walk into the New York Stock Exchange building and shout, "I want to buy Apple stock." Instead, you use a broker, an online platform like E-Trade, Fidelity, or apps that have become popular in recent years. These platforms let you buy, sell, and track shares from your phone or computer. Some even allow you to buy fractional shares, which means if a single share of Google costs $2,000, you can still own half or a quarter of a share with a smaller investment. This has opened up investing to people who don't have thousands of dollars to start. Understanding stocks also means understanding some basic terms. Market capitalization is one. It's the total value of a company's shares, price times number of shares. Big companies like Microsoft, Amazon, and Apple have huge market caps. Smaller companies have much lower ones. Then there's the IPO, or initial public offering, which is when a company sells stock to the public for the first time. Every company you can invest in today started as a private business, and at some point many choose to go public, so everyday people can own a piece. Let's talk about the stock market cycle for a moment. Markets go through periods of growth and periods of decline. A bull market is when prices are generally rising. A bear market is when prices are generally falling. These cycles reflect broader economic forces. In a bull market, optimism and confidence drive prices up. In a bear market, fear and pessimism push prices down. Knowing this helps you see why stock prices fluctuate daily. It's not always about the company's performance, but also how investors feel about the future. Now, many beginners fall into some common traps. One of the biggest is buying stocks based on hype rather than research. Just because a YouTuber says a stock is about to explode doesn't make it true. Or selling a stock too early because it dipped for a few days. Remember Tesla's wild swings? Investors who panic sold during temporary drops missed out on big long-term gains. Emotional decisions, rather than informed ones, are how many people lose money in the stock market. You might wonder, is investing in stocks risky? Yes, but risk can be managed. Stocks do go up and down. They react to company earnings, economic news, global events, even tweets sometimes. But historically, over long stretches of time, the stock market has grown. That's why long-term investing, holding stock for years or decades, is often recommended. If you invest in a strong company and hold while it grows, you give your money time to work for you. Let's pause and think about something practical. If you had $1,000 right now to invest, would you put it into a large company like Amazon or Tesla? Or would you spread it across several companies? Deciding this sets the tone for your investment style. Some people choose to invest in a few big tech stocks, thinking they will continue to lead innovation. Others diversify, spreading their money into different sectors like healthcare, energy, and consumer goods to reduce risk. Either approach has its merits, depending on your goals. Another thing stock market beginners sometimes overlook is compounding. It's when the returns you earn start earning their own returns. Imagine you invest money that grows 10% each year. The first year, your money grows by that 10%. The next year, you earn 10% not just on your initial amount, but also on the gains from the first year. Over long periods, this effect can turn a modest investment into a substantial sum. This is why experts say time in the market often beats timing the market. Now let's look at some everyday life examples to make this even clearer. Suppose you love streaming shows on Netflix. Netflix is a publicly traded company. If you buy Netflix stock, you are investing in the services you enjoy. You use the product, understand the business model, and have a personal connection to the brand. Another example is NVIDIA, a company known for making powerful graphics chips used in gaming and artificial intelligence. As demand for AI and gaming hardware grows, many investors have put money into NVIDIA shares hoping the company's growth will continue. It's important to realize that stock investing isn't only about big tech. Consumer brands like Nike, Starbucks, or even Disney are publicly traded. When you buy a pair of Nike shoes, drink Starbucks coffee, or watch a Disney movie, you're interacting with companies whose financial performance affects stock prices. When these companies expand into new markets, increase profits, or launch successful products, their stock prices tend to rise as investors take notice. At the same time, external events can affect stock prices. Global economic slowdowns, interest rate changes by central banks, or geopolitical events can trigger market reactions. For example, rising interest rates can make borrowing more expensive for companies, which can slow growth and put downward pressure on stock prices. This doesn't mean the stock market always falls, but it means investors must understand the larger economic context in which companies operate. Stock investing also includes understanding valuation. A stock's price alone doesn't tell you whether it's a good buy. You have to look at earnings, growth prospects, competition, and how the company's business model works. For example, two companies may both be trading at $100 per share, but one might have strong profits and steady growth, while the other has weak financials. Knowing how to evaluate these differences helps you make better decisions rather than following trends blindly. Another real-world example is Apple. Apple has become one of the most valuable companies in the world by selling products people love: iPhones, iPads, Macs. If you bought Apple stock years ago and held it, your investment would have grown significantly. Apple also pays dividends, so investors not only saw price appreciation, but also received regular payments. Understanding stocks also means understanding psychology. Market sentiment, how investors feel, can sometimes drive prices more than actual company performance. Fear and greed are powerful forces. In times of optimism, stocks can become overvalued as people buy aggressively. In times of fear, even strong companies can see their stock prices drop as investors rush to sell. Recognizing these emotional patterns helps investors avoid panic decisions that often lead to losses. Now, let's reflect for a moment. If you were to choose one company whose products you use every day and invest in it, which would you pick? Would it be a tech company like Google, a retailer like Walmart, or maybe a brand like Coca-Cola? Thinking in these terms helps you connect personal experience with investment decisions. Taxes are another practical part of investing. When you sell a stock for a profit, you usually have to pay taxes on the gains. Dividends are also taxable in many countries. Some investment accounts have tax advantages that let you defer or reduce taxes. Understanding this is important because taxes affect your real returns. Planning your investments in tax-efficient ways can make a significant difference over many years. Global investing expands your opportunities. Companies in fast-growing economies can offer growth prospects beyond your local market. For example, tech companies in Asia or emerging markets might grow faster than established companies in the United States. This doesn't mean ignoring local stocks, but smart investors diversify across regions to spread risk and capture global growth. Investing isn't just about money. It's a way to participate in the growth of businesses you believe in. When you invest in a company, your capital helps that company develop new products, hire workers, and expand operations. This connection between individual investors and global business growth is part of what makes the stock market unique. You've now seen how buying a stock means owning a part of a company, how investors can make money through price increases or dividends, and why understanding companies and industries matters when making investment decisions. Remember, investing isn't about luck. It's about knowledge, patience, and thinking long-term. Even small investments over time can grow significantly if you stay consistent and make informed choices. If this video helped you understand stocks a little better, make sure to hit the subscribe button and join us here at PrecisionNet. We dive into topics like this regularly to help you understand money, investing, and the economy in a simple, clear way. I'd love to hear from you. Which company would you start investing in if you had the chance today? Drop your thoughts in the comments, and let's get a conversation going. Thanks for watching, and we'll see you in the next video.